All right, let's dive right into this explainer and explore the exact macroeconomic levers central banks use to influence global markets, and ultimately, your very own wallet. We hear about central banks, like the Federal Reserve or the European Central Bank, constantly in the financial news. But for most of us, what happens in those closed-door committee meetings feels pretty removed from our personal bank accounts. Well, today, we're going to bridge that gap. We're breaking down the architecture of monetary influence to see exactly how a single policy shift can dictate the price of your groceries, the yield on your savings, and the broader job market.
Here's our roadmap for today. Meet the central bank, the interest rate lever, impact on inflation, impact on jobs, your everyday finances, and finally, the delicate balancing act. Let's get right to it.
Section 1. Meet the central bank, the origin of the ripple effect.
So, when we talk about how these central banks operate and throw their immense weight around, we first have to ask a foundational question. What exactly is this tool they use called monetary policy? We hear financial analysts toss this term around constantly on TV, right? But what's actually happening behind the curtain?
Well, it's essentially their master playbook. It's the strategic set of actions they take, primarily by adjusting interest rates, to directly influence borrowing, spending, and jobs. Think back to Paul Volcker taking over the Fed in the late 70s. He notoriously hiked rates to unprecedented levels just to crush runaway inflation. It's literally the ultimate tool they have to check the economy's pulse, seeing if prices are rising way too fast or if market liquidity is drying up, and then steering the whole macro environment back to steady waters.
Moving on to Section 2, the interest rate lever, controlling the flow of money.
You often hear monetary policy compared to driving a car, and honestly, it's a brilliant analogy. Altering the benchmark interest rate is really about changing the fundamental cost of capital. Lowering rates, that's slamming on the accelerator. Capital gets incredibly cheap to borrow, corporations finance massive projects, and consumer spending just takes off. But raising those rates, that's hitting the brakes. It drains liquidity, pumps up the cost of debt, and forces everyone from massive multinational conglomerates to everyday consumers to scale back borrowing and, as a result, scale back their spending.
It actually follows a super precise mechanical chain reaction. Step 1, the central bank decides to raise that baseline interest rate. Step 2, banks pass that hike right along, meaning borrowing costs shoot up across the board. Step 3, because servicing debt is suddenly way more expensive, people and businesses just naturally tighten their belts and spend less. And finally, Step 4, since you've got less money chasing the exact same amount of goods, inflation finally begins to cool down. Which brings us to Section 3, impact on inflation. Taming the price of things. If you look at most of the major central banks, you'll see they are usually aiming for a target inflation number right around the 2% mark. And that's not just an arbitrary guess. It provides a crucial buffer against deflation while keeping overall prices stable. 2% is basically the sweet spot where your purchasing power stays predictable, yet businesses still have the pricing power they need to grow margins and actually boost wages.
Now you're probably thinking, wait, if inflation makes things expensive, why not just aim for zero? Keep prices exactly the same forever, right? Actually, scratch that. 0% inflation, or even deflation where prices fall, is highly dangerous. Think about it. If you know that a new car or fridge is going to be cheaper next month, you'll wait to buy it. And if everyone waits, consumer spending completely freezes. Businesses stop making money, wages stagnate, and the broader economy basically stalls out. So that 2% target, it's literally the pulse of a living, breathing economy.
All right, Section 4, impact on jobs, employment dynamics.
So as borrowing costs climb under higher interest rates, corporate expansion takes a massive hit. If an 8% hurdle rate suddenly makes a new production facility totally unprofitable compared to a 3% rate, well, those expansion plans get shelved instantly. And when expansion halts, hiring freezes. It directly cools down corporate hiring and fundamentally shifts the job market. Look, it's a harsh macro reality, but sometimes a central bank has to intentionally loosen the labor market just to keep inflation from spiraling totally out of control.
Next up, Section 5, your everyday finances, the micro impact.
Let's talk about what this actually means for you, because there's a huge real-world trade-off here. We tend to view high interest rates as universally bad, but it really just depends on which side of the equation you're on. Sure, high rates make getting a mortgage or financing a business way more expensive, absolutely. But on the flip side, they make your high-yield savings accounts soar. Suddenly, that cash you have parked in a money market fund is generating a highly meaningful return. Conversely, in a low-rate environment, it's an amazing time to borrow, but your savings yield will drop to practically zero.
The absolute most crucial point to take away from this is that literally everything is tethered to that initial central bank decision. From the mortgage rate you lock in, to your credit card APR, to the financing on your auto loan. Even the inflation hitting your grocery bill and the yield on your savings account are just trailing indicators of monetary policy. Those board members sitting in a room talking about basis points, they are effectively deciding the margins of your personal household budget.
And finally, Section 6, the Delicate Balancing Act, navigating the ripples.
You see, the central bank operates under what is essentially a highly complex trilemma. They're constantly trying to juggle these massive competing priorities: taming inflation, maximizing employment, and somehow sustaining overall economic growth. It is an incredibly difficult tightrope to walk. If they drain liquidity too aggressively to kill inflation, they risk causing massive job losses and plunging us into a deep recession. But if they keep capital too cheap just to save jobs, inflation might run wild and destroy everyone's purchasing power. It's a continuous, intensely delicate calculation.
As we wrap up this explainer, I want to leave you with a final provocative thought. We've seen how this invisible architecture of monetary policy connects the highest levels of global finance right down to your personal balance sheet. So the next time you see a headline about the central bank holding a meeting or tweaking those baseline yields, don't just scroll past it. Stop and ask yourself, are they injecting liquidity or draining it? And more importantly, how will their next move completely reshape your own personal financial plans this year? Thanks so much for exploring this with me.